Thanks for clicking on our video. I'm going to take a cue from behind me with our Canadian Heritage Minutes and try and make this video a little briefer than the other ones have been. So I'm going to jump right into it. Why do interest rates in Canada for mortgages change? Why does a variable rate go up and down? Why do fixed rates go up and down? I'm going to explain the key factors that dictate those rates in the next couple of minutes. So let's start with variables. It's quite simple. The Bank of Canada meets 8 times a year. During those meetings, one of the things they do is set the target overnight rate. The target overnight rate is the interest rates that the Bank of Canada imposes on other financial institutions like TD and Scotia, and it's the costs that they have to incur for borrowing money from one another. So when the Bank of Canada increases that cost to the banks then increase the cost to their borrowers, us, who have mortgages with them. So if the target overnight rate with the Bank of Canada goes from 3.5% to 1.5%, if the target overnight rate with the Bank of Canada goes from 3.5% to 4.5%, that 1% increase is going to be seen on banks' prime lending rates. So if you have a variable of 2% minus 1, it's now going to be 3% minus 1. So your net interest rate has increased by 1 full percentage point. So whenever you hear about the Bank of Canada changing interest rates and they're going to be going up at the next meeting, that is variable interest rates. It has nothing to do with the fixed interest rates, although the reasoning why they might change it is also in relation to why fixed interest rates are moving. So fixed interest rates, the main determining factor of why those will move are bond yields. A government bond has a yield. The higher the yield, the less people are buying them. The lower the yield, the more people are buying government bonds. Government bonds are essentially investments in the government. It's a safe place to put your money where you earn interest. So during a recession, people don't want to be investing money in the stock market because it's too volatile. So they're going to put their money that they have somewhere safe where they can earn small amounts of interest on it. So when you see fixed interest rates at 1.5%, below 2%, that's because the bond yields are low because people are putting their money in government issued bonds. If you start seeing the bond yields go up, it's because people are investing their money more freely in the market, and there's better optimism on future economic growth. The Canadian economy is doing well, and you're going to see interest rates at a more moderate level. So if you track bond yields 1 year, 2 year, 3 year, 5 year, when those go up, the fixed interest rates for mortgages will be going up as well. If you look at bond yields when they're on the decline, you're going to start seeing mortgage fixed rates on the decline. So yes, really, really low mortgage rates are fantastic for people buying a home, but chances are you're not in a great place economically within your market. So Canada's economy, if the bond yields are low, chances are Canada as a whole is not doing that great. So those are the key determining factors on how mortgage interest rates are dictated. If you ever wanted to see what the future forecasted interest rates are, have a look at what the Bank of Canada is saying at their meetings. Have a look at the future outlook on bond yields. What's happening in the market? How is inflation? What's the economic growth looking like? Are people putting money into the stock market, or are people buying up bonds? If you look at those indicators, you're going to have a better sense of where interest rates are going for Canadian mortgage borrowers. I hope this information has been helpful for you. Please subscribe to our channel so you can stay up to date with more videos that are being released every month. And please reach out to us if you ever had any questions regarding a mortgage here in Canada at info@oakmortgage.ca. Thanks.